So you're thinking about moving to Bellingham, Washington, but you're concerned about high interest rates. Well, in this video, I'm going to share with you 4 different ways that you can compete with these currently high interest rates. And if you stick around till the end, I'll share with you what I believe is the best tool for this particular problem. We're going to get started right now. Hey, if this is your first time to the channel, we encourage you to like, subscribe, and hit the bell for notifications so you can keep up on all the content that we're releasing about Bellingham, about Whatcom County, and all the great things that are going on here in this area. My name is Jeff Engen. I'm with MJB Real Estate Group here in Bellingham, and every day we get calls, texts, and emails from people just like you who are considering a move to this area, and we absolutely love it. So whether you're thinking about moving tomorrow, 10 months from now, sometime in between, we encourage you to reach out. All of our contact information can be found below, and we are standing by and ready to help in any way that we can. But for now, let's talk about interest rates. All right, so the first thing that we want to do as we dive in and talking about interest rates is provide a little bit of historical context on rates to help us better understand what might be defined as high versus low or somewhere in between. So if we go all the way back to the year 2000, 22 years ago, interest rates on average for an annual basis were right above 8%. If we fast forward from that time to 2008, which was the time of the housing bubble, rates at that point in time were slightly above 6%. And if we look at the last 10 years, on average, rates ran anywhere between 4 and 5%. Now, we have in the last 18 months had rates that have gotten all the way down into the 2s, which is historically low, never seen before. And at this present time, as of filming this video, October the 6th, 2022, rates are hovering just below 7% on a conventional 30-year mortgage. So a bit of context, compare and contrast to where we've been going back 20 years ago, where we were at the time of the housing crisis in 2008, and what things have looked like over the course of the last 10 years, 2 years, and bringing us up to present day. So let's dive into talking about your options for reducing your interest rates. Now, option number 1 for combating these high interest rates at this point in time is through what is known as a buy down. Now, a buy down is simply a way for a borrower to pay what is referred to as points at the time of closing to reduce the rate of their mortgage. Now, a point is going to be defined as 1% of the financed amount of a loan. So, for example, if you had a $500,000 mortgage, you were putting down 20% on your purchase, it would provide a balance of $400,000 on that loan. Well, 1% of $400,000 is $4,000. And so $4,000 is what it would cost you to buy 1 point for rate reduction on your loan. Now, the amount that a rate is reduced is going to vary from lender to lender, from circumstance to circumstance. But for our example, let's suggest that 1 point is equivalent to a 0.25% buy down. So if rates were currently at 6.5%, and using the example that we've just laid out, $4,000 being equivalent to 1 point and equal to a 0.25% reduction, it means that that 1 point would reduce your rate from 6.5% down to 6.25%. Now, you could take that a step further. You could say, I want to buy this rate down to 6 even, and that would cost you 2 points or $8,000. Again, you're going to need to talk to your lender to figure out what types of products they're offering, what the current market conditions are, and the percentage, the point, if you will, is always going to be equivalent to 1% of the financed amount. But the amount that the rate can be bought down is something that is variable and something that you need to talk to your lender about. So option number 1 is a buy down. Option number 2 is what is known as an adjustable rate mortgage. So if you've shopped for a mortgage before, if you've purchased a home before, you've likely had a lender talk to you about a fixed rate mortgage as well as an adjustable rate mortgage. Now, an adjustable rate is going to be reflected as ARM. You're going to see ARM loans that are often offered alongside a 20-year, 30-year fixed mortgage. What's different about an adjustable rate mortgage is that it is going to be a fixed rate for the predetermined period of the loan. ARMs are offered typically in 3 years, 5 years, 7 years, in some cases 10 years, and then it's going to be variable and evaluated on a recurring basis, which is also defined by the type of loan, type of ARM loan that you're taking out. So in the case of a 5-1 ARM loan, your interest rate is going to be set in stone for the first 5 years of the loan, and then it's going to be variable and it's going to be evaluated on an annual basis as indicated by the 5-1. You'll also occasionally see something like a 5-6 ARM. Now a 5-6 ARM is going to be the same situation with regards to being a fixed rate for those first 5 years, but it's indicating to you that then it will be a variable rate that will actually be adjusted every 6 months thereafter. Now, when rates have gone historically low down to the 2s, the 3s, adjustable rate mortgages were really not relevant, really not employed, because there wasn't an advantage from a rate perspective to pursue an adjustable rate as opposed to a fixed rate. As rates have begun to climb, to get back in the 4s, the 5s, many lenders are offering adjustable rate mortgages at a more favorable rate than the current fixed rate mortgages that are on the market. Side note is that most people will not live in the home that they're purchasing for more than 7 years, particularly if this is a first home. So when you're acquiring a 7-year mortgage as opposed to a 30-year mortgage, some might think, well, I would rather just lock in for 30 years and know that I'm gonna have that rate for the life of the loan, not deal with the variability of the rate that could happen after that 7-year period. But it's unlikely that you're going to be there 7 years. If you were, it's very likely that you're going to go ahead and refinance that loan when rates improve, and you're going to lock into a 30-year mortgage and a 30-year rate at some point in the not so distant future. So an ARM, an adjustable rate mortgage, can be a great way for you to secure a better rate on your purchase than the current 30-year fixed rates. All right, so option number 3 for you to combat these currently high interest rates is to leverage a relationship with a credit union. Now, why is a credit union different than a mortgage broker who you've perhaps spoken with before? Well, the difference is that the credit union is often member owned, and the credit union will often have loan products and programs in which they will continue to own and service the loan for the life of the loan. As opposed to a mortgage broker who is focused on making sure that your particular situation fits into particular boxes to conform to the standards of a conforming loan and to be able to sell that loan to a third party once that transaction is complete, once you've acquired your purchase. So with that in mind, when we're talking about a conforming loan that's going to be sold to a third party, that third party is going to have very specific requirements with regards to your income, your employment history, your debts, that will satisfy their requirements to be able to purchase that loan from that mortgage broker, versus your credit union is not concerned necessarily about fitting you into that box, because they're going to continue to own and service this loan for its entire life. With that in mind, they oftentimes have rates that are more favorable. And just as an example, with rates here nearly into the 7s at the time of making this video, I have come across a couple different credit unions who have rates that are still in the high 4s for a very comparable product to what you would be paying otherwise, upwards of 7%. So option number 3, get connected with a credit union. Figure out what types of products they might have for you that could beat significantly these interest rates currently offered elsewhere. All right, so last but certainly not least, and again, what I would argue is the most advantageous resource for you at this point in time to combat these high interest rates is through what is known as a 2-1 buy down. Now, we talked a little bit about buy downs in opportunity number 1 for reducing rates. And again, that's where you're paying points at the time of closing on a loan to reduce that rate for the duration, the entire life of the loan. The 2-1 buy down is a little bit different. Really what the 2-1 buy down does is just focus on the first 2 years of the loan and to more significantly impact the rate. So the way that this works is it's actually required by most lenders that the seller is the one who is funding the 2-1 buy down. We'll talk about that more momentarily. But what this looks to do is to reduce your interest rate by 2 full percentage points in the first year of your mortgage and by 1 full percentage point in the second year of your mortgage. And so let's take an example. Let's say you had a $500,000 home that you're looking to buy somewhere in Whatcom County, and you intended to put down 20% on that purchase. The current interest rate is 6.5%. Well, your monthly payment on that loan in that scenario is going to be $2,932 per month. That's going to include the principal, the interest, your taxes, and your insurance, all rolled into one monthly payment. Now, if we employ a 2-1 buy down, we would actually take that 6.5% rate in your first year and we would drop it all the way down to 4.5%. What that's going to do to that same purchase is it's going to make your monthly mortgage payment $2,431, which is a $501 per month saving for the first 12 months of purchasing that home. In year 2, your rate will go up 1% or down 1% from that original 6.5% or up from that original 4.5%. But a 1% savings in year 2 is going to make that monthly payment $2,675 per month, which is still a $257 savings per month in the second year of your loan. Now, as I shared before, most lenders are requiring that sellers are funding this 2-1 buy down. So what does that look like? Well, in this example, we use a number, an approximate value of 2.5% of the financed amount. So in our example of a $500,000 purchase with 20% down, you have 2.5% of $400,000 that's being financed. It will cost roughly $10,000 to fund this 2-1 buy down. Now, in this market where things have slowed down, where interest rates have increased, where there's not the same degree of competition as there once was just even a short time ago on these homes, we're seeing homes sit on the market longer. We're seeing inventory build. And because of that, sellers are making concessions with regards to offers that they're receiving on their home. So that could be a reduction in price, but more valuable for you arguably is to, instead of offering $10,000 below list, is to offer list and to ask for this $10,000 credit to fund this 2-1 buy down. Now, the reason I believe this is so valuable is that we've got it on good authority. Of course, nobody has a crystal ball, that rates are going to go below 5% in the relatively near future. Maybe that's 2023, maybe it's not until 2024, but that it's anticipated that rates will come back down. And when they do, you'll be in a great position to refinance. So we're really looking to address this particular concern with these high interest rates in the first 2 years of this mortgage, allowing you to refinance at any point in time without penalty. In fact, these funds that are coming from the seller are effectively being put into an account that is directly correlated to the amount of savings that you're experiencing on a monthly basis. So you can just think of it as like a debit account where those funds are being applied to the loan in tandem with your payment to make up the difference as to what it would be if you never had that rate reduction. Well, that's being done on a monthly basis until those funds run out. Let's say you're 6 months in to your mortgage on your new purchase and rates all of a sudden drop down to the low 4s and you decide, you know what, I want to go ahead and refinance now. Well, great news. You can actually take the remaining balance that's sitting in that account that's come from the seller to fund this 2-1 buy down and actually apply those funds towards your refinance so you never lose money that was put up initially. I do think, again, this is the best way for you to address this issue of high rates at this point in time, and I do encourage you to find a lender who can offer this particular program to you. If you're having trouble with that, reach out. Would love to help. We've got a number of great partners here locally that are excited to partner with you on a 2-1 buy down. Hey, as always, I hope this has been helpful to you. Really encourage you to like, subscribe, hit that bell for notifications so you can keep up on all the content we're releasing. And again, all of our contact information can be found below. We're standing by and ready to help in any way that we can, be it rates, be it real estate knowledge in general. We are here for you and excited to support you. Really want to thank you for taking the time to watch this video. Look forward to seeing you again soon. Thanks so much.